Welcome back. Today we're going over another small cap stock. It's only got a market cap of about $250 million, and it makes the list on the Magic Formula as one of the top 30 value stocks, okay? I'm going to go over that. One other disclaimer, this is a stock I own, and it's one that I'm up pretty big on, so just take that with a grain of salt, whatever I say, because I'll probably have some positive bias, towards the company. So let's talk about IMMR. What do they do? They're in the technology licensing field, I would say. You can read more about it. This is their 10K. If you go to the table of contents and you go to the business factor, you should do this for any stock you own or one that you're thinking about buying. This is a key, read the business overview. They also have a business strategy, so that's good to read. I'm going to go to their actual website to show you a little bit more about what they do. So this is their homepage, and their big technology is haptic technology, which means it's not the touchscreen itself, but it's the feedback that you get from the touchscreen to make it feel like you're pushing a real button, okay? Another example of this is on like the PlayStation controller, how the trigger, let's say you're like shooting a bow and arrow or something on the new PlayStation controller. As you like pull back further, the trigger will have more resistance. It's like this interaction between the touch device and what's going on in VR, right? And that's kind of where my quote up top came from, because I think that this technology, while they've been doing it since I think 1993, if you read the About Us, let me pull that up, yeah, back in 1993, it might have been a little ahead of its time then, but I think now with the Metaverse and Oculus and all that, I think that this technology has a really large runway, okay? So that's kind of the general thesis for the company. What I'm going to do though is go into the financials and show you why it's a Magic Formula stock, okay? Real quick refresher on what is a Magic Formula stock. Okay, so what I have here, this is magicformulainvesting.com. I'll link this. You can create an account for free, and basically what it does, and this is Joel Greenblatt, he has a formula that ranks the top 30 stocks over whatever market cap you specify, and ranks the top 30 value stocks, okay, or 50. So I'll do 30. So if I scroll down, you can see IMMR does make the list right here, okay? Now, it's not in any order, it's in alphabetical order, okay? So you don't know which one is the most value stock or the least, which one is number 1 versus number 30, but these are the top 30, okay? So what goes into the Magic Formula, that's going to be what we talk about on the financial side, okay? So you'll see when we get to that. All right, so let's get started. Let's go to their income statement first. This is every quarterly report going back to 2015, okay? So March 2015. The revenue's actually been pretty flat besides this big jump in 2018, and you see they're making, if I just sum the last four, they're making, this is $38 million on a yearly basis, okay? So revenue's about $38 million. If I go to, this is what's crazy though, if I go to net income, and where is net income? Net income to common stockholders. Look what happens if I sum the last four here. So the last four here is $30 million. I know that you can't see it, it's off screen, but basically these last four numbers here sum to $30 million. So what's happening is you have a net margin of 30 divided by what did I say the other one was, like 38, I think. So 80% net margin, that is crazy. Okay, that's awesome. And the other thing you always want to look at though is like, okay, maybe income's high, but what is cash flow doing? So if I jump to the cash flow statement real quick, you can see that operating cash flow, okay, so this is net income operating cash provided by operations, right? If I sum these last four, it's $40 million, so more operating cash flow than revenue. That's pretty wild, right? And how does this translate to free cash flow? This is one of the reasons I really like this stock. Watch this. Watch the operating cash flow and free cash flow graph. Look at that difference. There's barely any, right? Watch again. I'm going to switch to operating cash flow and free cash flow. Man, crazy. Okay, so what does that mean? That means you have pretty low capital expenditures. Okay, so if I pull up capital expenditures, watch this. You're only spending, at most one quarter you spent $250,000. Okay, that's and you're making what, $40 million a year in free cash flow? Pretty crazy. Okay, so what I want to do with that free cash flow though, and real quick, I'll go back to free cash flow. You can see it's up here about $10 million a quarter. What I want to do though is subtract out stock-based compensation, because this gets added back in for cash flow purposes, but it really is, it should be subtracted, okay? Because this is value that you're losing, because it's, what's going on is that they're paying employees in stock, okay? Which isn't a big deal. It's it's not bad, but you need to account for it, okay? And I haven't really done it before, but I want to do it in this video to show you how to do that, okay? So basically, all I did was do a free cash flow minus stock-based compensation, and that's this number here, okay? All right, so obviously, this is what we care about, right? What is cash flow doing for the company? And this number, if I sum up the last four, is actually $36 million a year, okay? So I want to keep that number in mind, the $36 million, and I'm going to use that to kind of talk about the magic formula. And to understand the magic formula a little bit, you also have to incorporate the balance sheet. Now, I can go to the balance sheet trends, but what I want to do is show you on the 10K itself, the balance sheet. So let me pull that up. Okay, so we're back to their 10K, and what I do is I go to table of contents, I find financial statements and supplementary data, scroll down until I get to the balance sheet. All right, here we go. All right, this is really interesting. Okay, so the total assets, $190 million, all right, as of December 31st, 2022. Okay, look at your total liabilities, $32 million. Okay, so you have, an equity of $160 million. That's usually not, something that I'm, it's not like I'm going to go out and buy a stock because of this, because of the book value, but look how much cash they have compared to their total debt. So their total current assets, $160 million, which is like cash and short-term investments. And then their total liabilities are 32. So they have enough cash to pay off all their liabilities, more than 5 times, okay? Pretty crazy, or I think right at 5 times actually. Anyway, magic formula wise, what are the two pieces of the magic formula? The two pieces are return on assets and then PE. Now, it's not exactly that, and Joel Greenblatt doesn't really specify. He doesn't give you the exact formula, right? But I've listened to enough of his lectures. I've read enough of his books, and I think what he does is he takes kind of what he thinks is owner earnings, which I think I kind of estimated with the free cash flow minus stock-based compensation. And then for the assets, I think he does tangible assets. And so what I'll do there is I'll say that 36 million, remember that was the owner earnings or the free cash flow minus stock-based compensation, and then divide by this 190. So what you get is 19% return on assets. That is awesome, outstanding. Okay, if you have assets that you're making 19% on, that's just really strong. Okay, so that's one piece of the magic formula. The other piece is PE. Okay, so you take that same number, the 36, and you divide it by the market cap. Okay, but you want to include cash and debt in that equation as well, right? So to get the total amount of like the adjusted market cap, what you would do is I'll take what the market cap is right now, 247, all right, and then I'll add the total liabilities. So I'll add, $32 million, because that's like, extra liabilities that you have to take on. And then I'm going to subtract out current assets. Okay, so I'm going to subtract out 160. And our kind of adjusted market cap is 119 million. So you can see now what I do is I take that 36 million again, divide by 119, and I get that it's actually got an internal rate of return based on owner earnings and an adjusted market cap of 30%, okay, which is also really strong. Okay, so those are the two pieces of the magic formula, I think, as I see it. I don't know. I've just kind of had to decipher it from looking at a lot of companies and listening to Joel. But either way, this is really strong. Okay, it definitely checks both boxes. It's how good is the company at running with its own assets, and then how cheap is it selling on the market. Okay, those are the two pieces. All right, so before we end, though, I want to talk about a few things that are a little confusing to me. The first one is not confusing, but some red flags and concerns. Some people might describe this company as a patent troll. Okay, so basically they have, I would say, hundreds maybe of patents. So in addition to the licensing fees, they've actually got some revenue that's come in from suing people who try to infringe upon their patents and stuff. And I think they actually have an active suit against Meta. So there's that. The other thing that's a little concerning is that while they did buy back some shares, you can see they have treasury stock here. They have more this year than they did last year. So they bought back some shares. While they did buy back some shares, they also did a special dividend, which was nice. I enjoyed the money. But at the same time, I'm thinking, why not just buy back more shares because your stock was so undervalued? So that was a little bit of a head scratcher as well. But anyway, that's just my 2 cents. Like I said, it is one I own, so take what I'm saying with a grain of salt. It's not advice, it's just kind of my thought process. And I hope you enjoyed the video. I hope you learned something. Like, comment, subscribe. I'll see you next time.